Hi, thank you everyone for joining us this evening. Uh, we with Sequoia and Search, we have created this four-part webinar series for you, wherein experts will talk about how should you go about raising your first round of funding, what are the steps involved, how do you need to pitch, what are the investors looking for, and for the first of these webinars, we are joined by Mr. Rajan Anandan, who is the managing director of one of the most prolific funds in the country, Sequoia Capital, and he will be telling us today as to how we can go about, preparing for the first round of funding. On over to you, Rajan.
Great, thank you, Gautam, and thank you also to the Startup India team for co-hosting this series of webinars. As Gautam mentioned, this is a four-part webinar series around what it takes to raise your seed round. Right. So if you're a seed stage founder or very early stage founder, and you're either currently in the process of raising a seed round, or you think that over the next 6, 12, 18 months, you'd like to raise a seed round, this series will hopefully be very helpful. I'll tell you a little bit more about the series as we get into it. But before I start, I wanted to make sure that all of you are staying safe. I know it's an incredibly difficult time in the world, for all of humanity. We're in the middle of this extraordinary healthcare crisis, and I hope that all of you, your teams, assume that many of you are startup founders or you're in startups, as well as your families are staying safe. So, on behalf of all of us, I hope that you're able to stay safe. So, what I'm going to do now is actually get into the material. So, the way that we're going to run this is we've got structured material that we're going to go through during this webinar series. So it's not your usual sort of ask me anything or your panel discussion. We've actually got content that we're going to walk through. And then as we go through it, please do ask your questions. We've got one of our team members who's going to keep track of the questions. And then maybe every 15 or 20 minutes, I'll pause and I'll take questions. And then hopefully we'll have time for questions at the end. And even if you don't get your questions today, this is a four-part webinar series every Saturday, 4 p.m. India Standard Time. And you can dial in, and I'm hoping that over the next 4 weeks, even if you don't get your question today, we will get your question by the end of the webinar series. So with that, let me try to pull up my deck here. Okay, hopefully you can see the deck. So this is the title of the series is called Raising Your Seed Round. It's your first round, and we'll get into what that could be in terms of investment ranges, etc. As all of you know, I don't need to introduce Startup India, but I wanted to acknowledge the incredible work that Startup India has been doing. Startup India was launched by the Honorable Prime Minister of India in January of 2016, and has been very, very instrumental in really helping in many aspects of developing the startup ecosystem in India, right? As those of you, I know there are a few of you that are not from India, dialing in from other parts of the region, but most of you are from India. I think all of you would agree that over the last 5 years, we have seen tremendous development of the startup ecosystem in India. I remember when I go back to the year 2010, there were less than 1,000 startups in India. There were 0 unicorns in the year 2010, and we had only a few $100 million of venture capital that was being invested in Indian startups every year. If you fast forward to 2019, which was last year, India had more than 40,000 startups, had 30 unicorns, and in 2019 we had $14.5 billion of venture capital funding, right? So our ecosystem has come a long way, and I must say that the government of India has been extremely supportive of startups, and Startup India particularly, is really focused on many aspects of the startup ecosystem. First and foremost, coming up with policies that are conducive to ensuring that we continue to develop as a startup nation. It's also very focused on capability building. I think many of you are familiar with a lot of the incubators, accelerators that have been set up at universities and things like that. I'll talk about a number of grant programs that are available for seed stage founders. I think it's important that all of you are aware of that, as well as many other things. But one of the things that I have been very excited about is the 10,000 crore fund of funds that was set up where with the objective of making sure India has locally developed venture capital firms. And as a result of that fund of funds, which is now deployed through SIDBI, we've seen quite large number of Indian venture capital firms, first-time fund managers that have got into the investing business, as well as partnership with academia, very, very focused on partnering with private sector. For instance, this webinar series is a partnership between Startup India as well as Surge. This is a little more context for those of you that are not from India. This is a flagship initiative of the government of India with the objective of building a strong ecosystem in India. And again, I think on behalf of the entire startup ecosystem in India, I must congratulate and thank the government of India for actually doing this. Surge is Sequoia's seed stage program, and the objective of Surge is to engineer rapid early progress for startups by enabling disproportionate access to capital, talent, network, and decades of company building experience. Surge was launched exactly 16 months ago. Our first cohort of Surge was in March of 2019 when we had 17 companies. It's a program that focuses on startups that are in India and Southeast Asia. So India, South Asia, Southeast Asia. Southeast Asia is Vietnam, Indonesia, Thailand, Singapore, and all the countries in Southeast Asia, as well as India, Bangladesh, Sri Lanka, Pakistan. So that's sort of the regional focus that we have. And we focus on partnering with exceptional founders very early in their journey, right? So it's actually a seed stage program, and so it's quite appropriate that we're having this session in partnership with Startup India. And we basically pick 15 to 20 companies, and the companies come from across India, South Asia, and Southeast Asia. We give those companies enough capital to help them, that gives them the ability to focus on company building. So each company gets $1 to $2 million of capital at the beginning of the program, and then we work with founders over a period of 14 weeks on all aspects of company building, right? So everything from product market fit to how do you actually think about growth, to how do you build sales teams, to how do you hire engineers, all the way through. And it's a program that you'll learn more about over the course of the series as we share examples with you. So as I mentioned, it was launched 16 months ago. We are currently in our third cohort. We have 52 startups across our three cohorts of Surge, 110 founders. Surge has invested over $100 million into these startups over the last 16 months. And we're an open architecture program. So we co-invest with others. 80% of our Surge startups have other co-investors. So we co-invested with most of the venture capital firms, angel networks, the most active angel investors across India and Southeast Asia. And also we help our founders raise their next round of capital. So if you look at our first two cohorts, Surge 1 and Surge 2, the Surge 1 and Surge 2 companies have in total raised over $250 million of capital. And what's obviously interesting here is that that's only been in the last 13 months or so. So that hopefully gives you a sneak preview of Surge. Now, in terms of the series, it's a 4-part web series. This is the first part of it. So today, what I'm going to talk about is what you need to do before you actually get into fundraising mode, right? So answering very fundamental questions like, when do you raise your seed round? Who do you reach out to, right? Who should you be targeting as you try to raise your seed round? And also, really, we'll spend a lot of time around what do investors want. Next week is the art of pitching. And there we're going to cover how do you craft, we're calling it the perfect pitch, but a compelling pitch. Why is your story important? I think it's important to understand what, why it is important, and therefore how should you craft it. And also we're going to share some very practical tips of do's and don'ts of pitching as a seed stage founder. Then the third one is stories from the trenches. We're going to have several angel investors and seed investors actually come and do a panel. In fact, I'm going to have a discussion with them where they will share sort of the practical ground realities as investors of what they look for, and you'll get to hear different perspectives, right? Angel investor, angel networks, online funding platform, and so on. And that we think will be very, very helpful. And then the fourth session we're going to have is around after the pitch, after you have interest from an investor, what should you look for in a seed term sheet, right? So in a seed stage term sheet, and what can you expect in the financial and legal due diligence process at the seed stage? And we find that a lot of companies are really not prepared, even after they get interest when they go into that. And as a result, because they're not prepared, it takes a long period of time. So that's the 4-part series. It's every Saturday starting today at 4 p.m. It's 90 minutes, so 4 to 4 p.m. to 5 p.m. India Standard Time. And again, if you're a seed stage founder, either currently fundraising or you think you might be fundraising over the next 6, 12, 18 months, we'd love for you to actually join our series. And this again is the first part of that series. So this is part one. This is before the pitch. These are the questions that we're going to try to address over the next next 1 hour 15 minutes or so. What's the right time to raise? Who should you raise from? What are investors looking for? And also I'm going to touch on what does the current funding environment look like. Obviously lots has changed over the last since March, since COVID. We're about 3 months now into COVID, and I thought it'd be useful for me to share, for us to share what sort of change in the fundraising landscape. All right, so now let's go to, as a backdrop, I wanted to start with this, which is sort of an odd thing to say, given the fact that actually this entire series is focused on how to raise your seed round. Start with something that is very important as founders, all of you to keep in mind, right? Fundraising is not the objective, right? You didn't become a founder to focus on fundraising, right? Fundraising is a means to building an enduring company. And I think this is really, really important to keep in mind, because I find, and all of us as investors, we find that founders spend too much time, too much energy, and put way too much focus on fundraising as opposed to building their company, right? And so fundraising is really not the objective. And I thought I'd spend a few minutes on this. So I wanted to share a couple of these names. What do these companies have in common? Zoho, India's still largest software as a service company. Zerodha, India's largest trading, one of India's largest fintech companies. Wingify, which is a very interesting SaaS company. Or globally, companies like Basecamp, Mailchimp, Patagonia, and so on. Well, you can't really tell me because we don't have an interactive format since we're live streaming this across multiple platforms. But what these companies actually have in common is that they have not raised a single penny of external capital. They're 100% bootstrap companies. Keep that in mind, right? Zoho, which is India's largest software as a service company, has not raised a single penny of external capital. Zerodha, which is one of India's most valuable and clearly very profitable financial services companies, has never actually raised any external capital, right? And the reason this is important is because you can build a very large company without raising any external capital. And I find that too many founders don't think about that, right? So they think about launching a company, they're focused on a problem, they're excited about a mission, but then very quickly they get to, okay, now I need to go raise funding, as opposed to saying, okay, how do I really build this company? And asking a very fundamental question of, can I build a company and get to a set of milestones? And in this case, actually build the entire company without raising any form of capital, right? So it's very important to keep this in mind as you're building your company. Okay, the second set of companies I want to talk about is, what do these companies, Microsoft, market cap of 1.4 trillion, Google, market cap of almost $1 trillion, Amazon, InfoEdge in India, or Atlassian, or Shopify, what do these companies have in common? Again, I can pause. Normally I pause and ask this question and I get a lot of reactions. But let's start with InfoEdge. I was just on another session with Sanjeev Bikhchandani, who's now the founder and now the executive vice chairman of InfoEdge. This is the Indian company that has brands like Naukri. Here's an interesting thing about InfoEdge, right? InfoEdge today has a market capitalization of $3 billion US. InfoEdge raised only $1.7 million before they went public. Before the IPO, they had only raised $1.7 million. Now, here's what's most interesting. Of the $1.7 million, 1.5 million of that was still in the bank when InfoEdge went public. And as those of you that have listened to Sanjeev Bikhchandani talk about his journey at InfoEdge is, as Sanjeev says, the best source of funding is your customers' money. If you can actually get your customer to pay for your products or services, that could be a consumer, that could be a business, that is your best source of funding, right? So Google, which is now almost $1 trillion, only raised $25 million of venture capital. Now think about it, a company like Google has only raised $25 million of venture capital. Now, if you're a seed stage founder, you could look at that number and say, wow, that's a lot of capital. But actually it's not, because if you've been in the Indian startup ecosystem for a while, you know that a lot of companies raise a lot of capital and they don't really eventually become valuable global companies, right? So again, the reason I like this, and I can go through the other examples as well, is these are all companies that haven't raised a lot of capital, right? And again, so the idea is fundraising is not the objective. Last thing I want to share is an interesting statistic, and this is actually specifically focused on Chinese unicorns. So with our last surge cohort, our second surge cohort, this was before COVID. We actually spent a week in Beijing, and we had one of the world's top investment banking leaders come and speak to the surge cohort about the Chinese tech ecosystem, and he shared that 20% of unicorns fail. So what does this mean, right? This says that even after you become a unicorn, and let's say you either raise 20 million or 50 million or $500 million, you became a $1 billion private company. That still is not a measure of success, because even after at that point, you can still fail, and 20% of companies after they become a unicorn fail. And again, it just goes back to the point that I mentioned, which is fundraising is not the objective, right? So the objective again is to build an enduring company, a company that is really going to have an impact on the set of consumers that you're targeted on the businesses that you're targeting on, and that needs to be the objective. Now let me go to this topic of changes in funding landscape. So clearly we are now about 3 months into COVID, and we often get this question of what has changed. I think the first thing to keep in mind is there's a higher bar for funding today, right? I call this the flight to quality. Investors are looking for high quality startups, right? And that's from the seed stage at Series A, at Series B, all the way through growth stage startups, right? So you'll hear this word high quality. Is this a high quality founder? Is this a high quality business? The second thing is, if it's a post-revenue company, there's a very, very clear focus now on strong unit economics. In fact, strong unit economics has become non-negotiable, right? So if your unit economics are not very strong, you're going to find that even very early stage companies are going to find it very difficult to raise funding. Of course, later stage funding companies are going to find it almost impossible to raise funding. Third thing is customer behavior has changed, and in some cases permanently, right? So if you look at a segment like edutech, right, over the 3-month period, the number of online users in India that use online education products is more than doubled. The number of Indian users who pay for education products is more than double, right? So clearly, because Indian users have been doing, and globally, right, these users have been doing, and by the way, it doesn't have to be only India, it could be Indonesia, it could be Bangladesh, right? So customer behavior has changed, and in many cases, these are going to be permanent changes in customer behavior. And also digital adoption, both for consumers as well as businesses, is leapfrog. I actually believe that if you take many industries, changes that would have taken 3, 4, 5 years have happened in 3 months. And that is very, very profound, and it actually bodes very well for medium to long-term outlook for digital startups all over the world. And finally, I think this last point is very important. The focus today is on what we call must-have products, right? So if you're building a SaaS company, really ask yourself, is this a must-have product either for SMBs or mid-market or enterprise, depending on who you're focusing on? And sort of the nice-to-have products or good enough products are really not good enough anymore, right? And what you'll find is that the funding investors are really have very little interest in sort of nice to have products today. So these are some of the changes that we've seen, and they're very profound and pretty deep changes. Now, what does this mean, being in the middle of COVID, if you're trying to raise a round of financing, what does it mean? Well, actually, firstly, you have to be a high quality business, but the sector that you're in is also going to have implications on your ability to raise over the next 3, 6, 9 months, right? Keep in mind that COVID is not a 1 or 2 month phenomenon, right? Economies are obviously opening up, but as you'll see, if you take a country like India, we're going to see a significant increase in cases from here. If you take a country like Bangladesh, Pakistan, Vietnam, all these countries, despite opening up their economies, are going to continue to see significant increases, and as a result, demand is going to be uncertain. So there are a number of sectors where COVID has been a positive. COVID obviously not positive for anybody, but there's been a lot of tailwind over the last, I'd call it 3 or 4 months, right? EdTech, online education, digital health, many parts of e-commerce, right? Especially online grocery e-commerce, remote work. You look at the stock price of what's happening to a company like Zoom or collaboration tools, companies like Slack, and we're seeing startups even in Asia, India, Southeast Asia that are focusing on remote work, collaboration tools, really beginning to see a lot of tailwind, a lot of investor interest in these segments. Gaming gaming, explosive growth in gaming across the world. Nutrition and hygiene, right? Direct to consumer brands that are focused on nutrition, hygiene are seeing explosive growth in demand. And finally, SaaS. I believe that this decade, right, the decade from 2020 to 2030, this decade is going to be the decade of Indian SaaS. And even in today, what we're seeing is a lot of interest in SaaS startups, especially if they've got must-have products. Now, if you've got a SaaS product that's sort of a nice-to-have product, then you're going to find it very difficult to raise financing in this environment. But if you've got a must-have product, then I think this is actually quite an interesting time. And finally, obviously that's on you see the green arrows growing up, but on the other side, you see the red arrows coming down. And these are sectors that have been deeply impacted, right? International travel, obvious reasons, right? It's going to take a long time before a large number of people are going to want to travel internationally. Obviously, people will, if they have to, go back to their home countries or have to, but it's going to be a long time. We're going to see international travel come back. Hospitality, pretty obvious. Offline retailers are beginning to open up. But even if you look at a place like China, although traffic is completely off, transactions are not quite there. Traditional food and beverages, so this is sort of restaurant industry, we think is going to be quite challenged for quite some period of time. So if you're either a new startup restaurant or you're actually selling products and services to restaurants, that might be challenging for some period of time to come. Fashion and accessories is very interesting, right? On the one hand, we've seen food, basics, essentials demand, being higher than what they were before. We've seen electronics, for instance, come back up very, very fast since the lockdown opened up 2 weeks ago in India. But we are seeing quite muted demand in fashion and accessories, and that's obviously quite understandable. Cineplexes, if you're actually selling, let's say, technologies to movie theaters and things like that, or you're in the ticketing business, that might be quite challenging. Co-working spaces, we do think that co-working spaces are going to be challenged because people are, especially startups, for instance, where co-working spaces had built their businesses on, at least many of them may struggle because startups have now figured out that they can actually work from home. And finally, I think the jury is out on how long it's going to take for ride sharing to discover. That's why I put a question mark where it's not clear yet how long it will take. And now don't get me wrong, all of these sectors will recover, right? The question is, how quickly will they recover, and what is the current funding sentiment if you're building a startup in these sectors, right? So I'd say that's sort of where we are. And now maybe what we'll do is, Payal, you'll have to
Yes,
sort of
yes.
interrupt me. If there are questions, I can pause now. Are there any
Yes.
questions, Payal, or shall I keep going?
No, there are a few, I think, related to some of the sections that you've covered now. So I'll just read them out. One is from Romil, and he's asking, how important is it to have a financial model to raise seed capital from Surge or others? And a related question, because you talked about Surge, is from Jigisha. Does Surge help in raising funds for a startup only on the basis of an idea versus a fully developed product?
Yeah, I think those are both good questions. Look, from a Surge standpoint, it is never too early to apply to Surge, right? So if you look at our second cohort of startups, there were 20 startups in our second cohort. When Surge decided to partner with them, when we actually decided to select them into Surge and actually invest in those companies, 6 out of the 20 companies were pre-launch. Right, so they were basically a team with a great idea, with a space that they wanted to go after. Some of them had started building their product, but they had not launched a product, right? Be it a consumer product or a B2B product. In fact, even today, we have several Surge 2 companies that haven't still launched, right? This is sort of, we had Upsurge, which is the end of the Surge program in January. So now we're talking about 5 months after Upsurge. So anyways, 8 or 9 months after Upsurge, we still have 2 companies that haven't launched, because one is actually in a deep tech space where they're actually building something that's pretty revolutionary, that's going to take a long time to build. So first answer is, it's never too early to apply to Surge. And then the other one was around the financial model. Look, you don't need a financial model to apply to Surge. As I said, right, if you've got a great team and you're going after a big market, and we believe that, and I'll talk about this in a minute, that the founding team has very strong founder market fit, and we think that there's a large market opportunity for you to be built. You don't need a detailed financial model. However, what you should think through is, eventually, you don't need to have a revenue model immediately, but eventually, is this a business that's going to lend itself to becoming a large business that will become profitable, right? So you don't need a financial model per se, but thinking through whether it can be a large business eventually is pretty important. Because even if we don't ask you that question, we are going to be asking ourselves that question, which is, can this become a very large business?
Okay, next question is Sumit wants to know, why do unicorns fail? Because you talked about 20% failing.
Yeah, it's a great question, right? The reason they fail is sometimes a company gets to unicorn status without having a viable economic model, right? And especially over the last 5 years, as those of you that follow sort of startups very closely, and you used to see it in the media all the time, right? You had a lot of companies that got built on the back of significant capital that didn't have strong unit economics, right? So if you get to be $1 billion, but you're still losing money on every order, and we, have had around the world companies like that. You've read some famous examples of companies that tried to go public, were not able to go public, etc., that were worth many dozens of billions of dollars, right? So at a simplistic level, the first big reason they fail is because they're not able to make this switch from having sort of, let's call it, poor unit economics to having very strong unit economics, right? Unit economics where the underlying financial economic health of your business. So I think that's the first thing. The second thing also, sometimes markets change completely, right? So look at the current environment. I mean, with COVID, companies that were doing very, very well, I showed you a set of sectors. In fact, the slide that you're looking at right now, there were if you're in one of these sectors that is deeply impacted, especially in a space like international travel, or in a space like hospitality. So for instance, if you're a large unicorn in international travel and you don't have 2 or 3 years of cash runway, you're going to be at risk, right? Because it's going to take 2 years for international travel, 2+ years, maybe 3 years for international travel to recover. So if you built this large company, which is still not very profitable, and has a large cost base, right? And the market completely changes, that could be. And the third reason is, look, if somebody comes up with a massively innovative model that essentially, is able to take over your market, right? And that happens sometimes too. And that's the interesting thing about technology is, things change very, very quickly, and you can have a new category of company emerge that will actually take market share away. So different reasons of why it happens, but keep in mind that in the technology space, you have to continuously keep innovating. You have to continuously keep reimagining your business.
Thanks, Rajan. A bunch of questions coming up on sectors and how investors are thinking about them. This one is, how should a consumer tech startup build a financial model for the seed stage when the revenue streams are unclear?
Yeah, I think as a consumer, so let me focus on a consumer internet startup, right? Because I assume that's what the reference is to. Because if you're building a consumer brand, right, India has now quite a number of direct-to-consumer brands. I mean, those are brands, whether they're in beauty or fashion or food, those are brands that generate revenue from day zero. So it's pretty, you have to actually have a pretty good sense of the unit economics. I think if you're a consumer app, I would, at the seed stage, what you should be focusing on is being very clear who the user is, right? Who's the consumer you're building this product for? Second, what is the need that you're trying to meet for that consumer? And third, how are you going to make sure that they love your product, right? So for instance, and I'll talk about this when we talk into what do investors look for, right? If you've already, let's say you built a product and you've launched it, we're really focused on, do you have user love, what we call user love, right? Do your customers, be it consumers or businesses, do they love you? Do they love the product that you built, right? And that's really what we are focused on. And our view is, look, if you get a large number, let's say you're building a consumer internet product, if you get a large number of consumers to use your product, use it very often, spend a lot of time on it, eventually you will find a way to monetize, right? Either through advertising, through commerce, through other ways, try getting consumers to pay for it directly. So we are less worried about that. We focus a lot, and this is one of the things that a lot of founders don't understand, is that investors really, really focus on, if you've already launched your product, right? If you've launched your product, and even if it's very, very early days, we focus on this notion of user love. Does this product have a lot of user love? And that is the thing that we focus on. And I'll talk more about that in a couple of minutes.
Thanks, Rajan. The next question is, what is your point of view on telemedicine, keeping in mind the current COVID-19 situation, and what's the scope for this sector post-COVID-19?
Yeah, I think look, telemedicine, is structurally very attractive long term because if you look at a country like India, we don't have enough doctors, we don't have enough hospitals. Most of India doesn't live in the big cities where most of the good hospitals are. So if you take sort of a medium to long term perspective, I think the sector looks very very interesting. The single biggest barrier we had to telemedicine was, as you know, in the month of February of 2020, telemedicine, full-fledged telemedicine in India was not legal, right? So a doctor could not prescribe could not prescribe medicine or treatment, etc., online, either online or on the phone. That was not legal. That changed actually as COVID set up, and as a result of that, we've started seeing a lot of early momentum in with telemedicine in India. In fact, yesterday I talked to a startup that's in South Asia, not in India, that's actually growing very very fast on digital health, specifically around telemedicine. So I would say, look, the medium to long term prospects are very strong. There's a lot of work to be done, right? So I do think COVID, we will see a spike, but this is something that structurally, because the legal framework is in place, consumers are beginning to understand the value of it, because you can actually talk to a doctor instantly, you can get diagnosed, you can get your medicine delivered, and so on and so forth. So we are actually very very bullish on telemedicine in many parts of the world. Hey, in the interest of time, Joy, shall we keep going? And then, Payal, shall we keep going?
Sure. Okay.
And then we'll take a few more as we go through. Just keep the questions with you.
Yes, we keep them ready. Yeah.
Yeah, we keep them ready. Okay. All right. Now we get to questions you should ask before embarking on fundraising, right? First one is, why do I need to raise? And this is a really, really important question. We find that too many founders, as soon as they incorporate the company, the first question they're asking is, let's go, and how do I fundraise, right? And so you should ask yourself, why do you need to raise, right? You should ask yourself, can I get to the next milestone without fundraising, right? Then there's a fundamental question about, how much do I need to raise? It's not an easy answer to that. We'll give you some ways to think about it. Who should I raise from? Very, very important question, right? And then also, what milestones do I need to raise, right? So that's actually a pretty important thing to think about. How long will it take to raise a seed round? I think most people underestimate how long it takes to actually raise a round. How many investors would I need to approach before I can raise a round, right? And then finally, what investors would look for. So these are questions you should ask before embarking on a fundraise. And what we're going to try to do now is try to give you more insight into these questions. Okay, how much do I need to raise, right? So firstly, there's no exact science around how much you need to raise, but there are good ways to think about it and bad ways to think about it, right? So let me spend a few minutes on this. So some good ways to think about it is, how much do I need to hit the next major milestone, right? So whatever that next milestone is, how much do I need to do that? Because companies do need to have capital to be able to do that, right? That's a good way to think about it, right? How much do I need for the next 18 to 24 months? Those of you that have been attending, COVID-related startup sessions have heard this a million times, which is cash runway, right? So what we tell all startups today is that try to have 18 to 24 months of cash runway, because this level of uncertainty is going to continue for a long period of time, right? The third one, a good way to think about it is, how much do I need to hire an A team, right? The single most important thing that you will do outside of finding product market fit at the search stage is really making sure you have an A team as your core team. So, right, you might need capital to actually go do that. So that's a good way to think about it, right? But there are some bad ways to think about how much do I need to raise, right? So here are some bad ways. There are many bad ways, but we'll just give you some, right? What is the maximum I can get away with raising? That is not a good way to think about it. That's a bad way to think about it, right? What did my peers raise, and can I do something comparable? Hey, look, X, Y, and Z raised this much, therefore I should raise this much. That's not really a good way to think about it. It's a bad way to think about how much you want to raise, right? What is the market for typical seed Series A these days? Everybody's like, what's a typical Series A? So therefore, maybe I should go raise that. Or what's a typical seed? That's a bad way to actually think about how you want to raise, right? The good way is, how much do you really need, right, to hit the next milestone, to build the kind of team you want to build, and also to have enough runway so that you can go build for 18 to 24 months. So those are good, and these are bad. Okay, now let's move to, how do you choose the right investor? So keep in mind that whoever is going to invest in your company is going to be with you for a long period of time, right? I'm sure all of you have thought about this, but it's going to take you 8, 10, 15, some cases 20 years to build the kind of business that you want to build. You want to build an enduring company, cannot get built in 3, 4, 5 years, right? So is this someone you would enjoy working with for a long time? Because if you're going to be building this company for a very long time, your investor is likely to be with you for a very long time. The second question you should really ask yourself is, can this investor be truly helpful, right? Because again, you want to have investors who are really your partners who are going to help you build your company. Is this person trustworthy, and are they aligned with your values, right? You have a core set of values as an individual which you're going to imbibe on your company, and asking this question is pretty important, right? Do they understand what you're trying to do? Do they buy into your mission, right? This is very important, and ideally they should actually understand the space that you're in and what it is to build the kind of company in the space that you're in, right? What do other people who work with this person say about them, right? You should do ref checks on your investors so that you can understand what is this firm or this if it's an angel investor, it's a person. If it's an institutional investor, it's a firm, right? What do other entrepreneurs who've actually got financed from this firm say about working with this firm, right? And the last thing I would say is, look, optimize for the right long-term partner, right? There are right long-term partners and there are partners who are not right for you. Again, it depends on all these questions that are above that I just talked about. Optimize for finding the right long-term partner and don't optimize for returns, right? I mean, I see at times where founders are taking financings from a partner because they got slightly better terms, as opposed to asking this very fundamental question of, is this the right long-term partner for your company, right? So these are some ways to think about the right investor. Okay, this is pretty important, right? Who should I raise from? Look, at the end of the day, who you should raise from depends on how much you need to raise. And keep in mind, be very, very thoughtful. We just talked about it, which is, figure out how much you want to raise, right? So let's say you're just getting started and, you need to raise, let's say, a couple of lakhs, 5 lakhs, up through, let's say, 50 lakhs or 75 lakhs. And if you have access to friends and family, right? These are people who know you really, really well. They're family members who are able to take the kind of risk capital. Now, remember, this is very risky, right? Most startups fail. So you want to make sure that this is truly disposable, that they can afford to do it. Or you have friends who've done very well, who've just known you for a long time, and they may not know the industry. So that's friends and family. And friends and family will not know much about what you're doing in your business. They won't have domain expertise, but they're a good source of capital if you can actually have access to that kind of capital, right? So we see a lot of startups, when they start off, they're basically going to put some of their own capital if they've been working for a while, as well as from friends and family, and that's usually sort of 5 lakhs to 50 lakhs. The second source that I find very few startups really leverage is grants, and especially government grants. I talked about Startup India, right? This government has been very, very progressive about coming up with a whole set of schemes for early stage companies, and I'll share some of them with you. There's quite a large number of them, but I'll share some of them with you. The third is angels and angel networks. So let's say you want to raise anything from 25 lakhs up to about 5 crore. You can actually go to angel networks, and India now has a large number of angel networks. I'll share some of the names with you, right? I'm not going to go through all the names, but I'll share some of the names with you. Then you have seed funds, right? Seed funds are seed funds. These are funds that only invest in seed stage companies, right? They will invest from 2 crores up through about 15 crores, right? So call it sort of $300,000-$400,000 up through about $2 million, right? These are seed funds. Then you have early stage funds, funds that span seed A and B. Most early stage funds in India, and I'll share a list with you, actually also do series A and series B. So they'll do seed, series A, series B. Then you have growth stage funds. Growth stage funds are funds that only invest in, let's say, $15 million and above. Right, and there are many of them. We're not going to focus on that segment today because this is a discussion about seed funds. And finally, you have venture debt funds, right? So once you've actually raised some external financing, you can also go to venture debt funds who are actually going to give you debt, not equity financing, right? So these are sort of the different sources of capital that you'll have as a seed stage investor. So now what I thought I'd do is just spend 1 or 2 minutes on each of these segments so you get a feel for it. Now, for those of you that are pretty advanced at fundraising, all of this is going to be very basic, but I'm hoping that at least for others, this might be helpful. There are many sources for government grants, right? Both at the center as well as at the states. And these are just some of them, right? So DST, Department of Science and Technology, has a program called Nidhi Prayas, right? Where they support ideation stage. So these are, you can be an entrepreneur startup with an ideation stage and you want to, let's say, raise your first 10 lakhs to get you off the ground. You can actually go and apply for grants there, right? Then you have DST has another seed stage support program that actually goes from, this is for early stage companies. So you have to be beyond an idea stage. You've launched a product or a service, but you're still very, very early stage, you get associated with one of the DST incubators, and you can get from 20 lakhs up to a crore, right? So this is actually, and these are grants, remember, these are not equity financing. So it's a great way to actually get your first source of capital to get off the ground. BIRAC, which is very, very progressive. If you're a biotech or a healthcare startup, they support a large number of early stage companies, and they go up to 50 lakhs of grants for biotech and healthcare companies, right? So if you're trying to build a biotech company, you need that 50 lakhs to just start building your product or service. This is actually a great place to go. And then finally, METI has a scheme called the Tide Scheme, which again is for very early stage companies. They can actually go from 4 lakhs up to 4 lakhs for proof of concept, 7 lakh for prototyping, and then up to 40 lakhs of grants once you actually get the product launched. So you could raise 50 lakhs from METI, right? So these are just some examples of grants that you can get from the center, but there are many more. Almost every ministry now in the government of India has grant programs, and then those of you in India know that many of the states also have startup grant programs that you can get access to. I find that this is a source, especially seed stage founders haven't really thought about and should think about more often. Angel networks, right? India has a large number of angel networks. Indian Angel Network is the largest angel network in the world now. Keep that in mind. Okay, it's the largest angel network in the world now. It's got hundreds of angel investors. Last year, IAN did more than 47 investments. They will invest from 50 or 75 lakhs all the way up to 5 or 6 crores, because with large number of angels, they're able to syndicate those kinds of and this is, keep in mind, a lot of angels come in and they would collectively invest into a company, and then you have R Ventures, you have the CIO Angel Network, you have Marwari Angels, Mumbai Angels, and so on and so forth, right? So many angel venture capitalists, which is a very, very active program. So do the research. If you're trying to raise, let's say 1 or 2 crores or 2 or 3 crores, do a lot of research around the angel networks and really apply to them, because many of them are very active. In fact, IAN, the Indian Angel Network, just in the last 3 months has done 4 investments, right? They continue to be very active through COVID. Then you have online platforms, right? Online platforms are basically as well as incubators. So let's take Let's Venture. Let's Venture is the largest online platform. If you haven't looked at it, please do go take a look at it. This is where you can list your startup. There are a large number of investors who are on the platform, large number of startups, and there are different ways in which you can connect to them, and your investors can come find you. Think of it as an online marketplace, but it's actually a highly curated, right? And this is actually a great way to do it. In fact, they did more than 50 investments last year in 2019. Again, from 50 lakhs up to 5 or 6 crores. If you want to raise, that's a good way to go. Similarly, AngelList, which is a global platform that's very active in India. You have 100x VC, where which is a large number of companies, if you will. And then you have incubators like Y Combinator and Techstars, right? So Y Combinator is a global, very well-known incubator program. Before COVID, this is where you actually went to the US, spent 3 months with Y Combinator. They will give you $150,000, so call it a little over a crore, and they'll take some equity in the company. Similarly, you have Techstars, which is now in Bangalore. So this is another set of sources of financing. And then you have a large number of seed funds and venture funds, right? So Surge is basically Sequoia's seed program. Sequoia is sort of the main, Sequoia, they think of Sequoia, and Surge is part of Sequoia. So for instance, if you're trying to raise $1 or $2 million, you should be applying to Surge. If you're raising, let's say 5, 10, $15 million, you go to Sequoia. Sequoia is basically, think of it as venture as well as growth. So series A, B, C, D. And then, you see a large number of names. There are a lot of names that are not included here, but, you have firms like Accel, like Lightspeed, like Kalari, like Matrix, like Nexus, who are basically the largest venture capital firms in India, who also are active in seed stage investing, right? And then you have firms like Bloom. All of you know in India, if you're in India, know Bloom, very, very active fund. Now their last fund is, the new fund is $100 million. They're going to be very, very active. And then you have actually sector-specific funds, right? And this is pretty important. You have Advantage Partners, which is based in Delhi, that is actually extremely focused on mobility investing, right? You have Fireside Ventures. Fireside Ventures is very focused on direct-to-consumer brands. So if you're trying to build a direct-to-consumer brand and you're trying to raise, let's say, 2 crores or 10 crores or 15 crores or 20 crores, you should certainly be going to Fireside Ventures, right? And then if you look at, let's say you're trying to build an ag tech startup and you want to raise 2, 3, 4, 5 crores, you should be going to Omnivore, because Omnivore is a specialized fund that actually does ag tech investments, right? So I won't go through all the names here, but what I wanted to tell you is there's many names here that are not here as well, right? But do the research on who are all the firms and what are they investing in, right? So for instance, as Surge, we look at all tech and tech-enabled companies, right? Consumer internet, online, offline. We have a large number of SaaS companies in our Surge portfolio. We look at direct-to-consumer brands. We look at deep tech. But for instance, if you're building a medical devices startup, a medical devices hardware startup, that may not be the right thing for us, right? But whereas some of these other firms actually would. So not every firm invests in all sectors, and I think it's very important that you keep that in mind. And finally, venture debt, right? India, this is a sort of a relatively new category of financing for startups in India, but it's very, very rapidly evolving. So whether you look at Innovate Capital or Trifecta, or SIDBI's venture fund program, again, there's venture debt, right? So the reason I wanted to share all these with you is because being very thoughtful about who you want to raise from, it becomes very important. So do the prep work, right? Every investor has focus areas. This is really important, right? Don't blindly go and talk to every single investor who's out there. Do the research to deeply understand the investors who invest in your sector, depending on the kind of business that you're trying to build, and also in the investment range that you're looking for, right? If you're trying to raise 50 lakhs, that's very different from if you're trying to raise 15 crores. And do the in-depth market research. Keep in mind, this does take time, but the research that you do will pay off in terms of who you want to approach. Now I want to go to the next section, and then we'll pause so that Payal can get the questions from all of you, and I'll try to answer them. So now I want to go to this section, arguably the most important section we'll talk about for this first part of the series, which is what are investors looking for, right? Look, first thing is what investors look for change depending on the stage that you're in, right? If you're a seed stage, what investors look for is different to what investors look for if you're trying to raise a Series A. So at the seed stage, the most important thing that your investors are going to look for is the team, is the founding team that you have, right? Whether it's a single founder, whether you're two founders or three founders, and let's say you've hired your early set of employees. They're really, really trying to understand the team. I'll talk more about that. Second, they're trying to understand the market, right? Simplistically, they're trying to say, look, is this market large enough where you can build a large business for it? And the third thing is, if you've launched a product, right, and you may not have launched a product, and keep in mind, it's never too early, right? If you have to, it's never too early. If you've launched a product, they're trying to understand that product, and specifically trying to understand, if you've launched it and it's in the market, how much user love do you have, consumers or businesses? So that's what seed is. On Series A, team needs to be more built out, right? So now you actually have not just the founders, but you have a strong sort of team in place. They again focus on market, making sure that the market is large enough to be able to build a big business. By Series A, though, they're looking for product market fit. And I'm going to talk about that. And this is really, really important, right? Product market fit is where you have found a set of consumers that truly love your product, right? And that market is sort of large enough. And then finally, they're looking for traction. So usually when you want to raise a Series A, you need to sort of have very strong traction, right? Both in terms of growth, in terms of these reasonable unit economics and so on. So what investors look for really depend on the stage that you're in. And one simple way to think about it, right? At the very early days, what you have is a team, which is you and your co-founders, and a story, right? And that is what you have to make very, very exciting. But very quickly, and start showing some proof that this product that you think has a lot of need in the market for, there's actually a market for. And then finally, metrics start mattering. So, from Series A onwards, metrics start mattering. And if you start thinking about Series B and C and D, by the time you get to Series C, really the investors are focusing as much, if not most, on metrics to make sure that this is a real business that is delivering the kind of economics that it should, in addition to looking at the team and the market. All right. So now I want to spend some time on what investors look for in a founding team. And this is really, really important because you should know that this is what we are asking as you're talking to us. And when I say we, I mean as investors, right? So founder market fit, this is a very important concept, right? You've heard of product market fit, but there's also something called founder market fit. And hopefully many of you are familiar with this. And the simple way to think about this is, what is this team's right to win in this market, right? What is it about the set of capabilities and experiences that you all have? Let's say you're two co-founders, right? Between the two co-founders, what is it that you've done in the past, the experiences that you've built that give you the insight and the set of capabilities to actually win in this market, right? So we're looking for that. Second is co-functional expertise. Ideally, we'd like to see a founding team that has some combination of these four things, right? Product, engineering, design and go to market. Go to market could be a combination of marketing and sales, right? Ideally, if you can have, let's say you have two co-founders and you have two of these, let's say product and engineering, right? Or let's say you've got product and sales, or you've got, let's say, engineering and sales. So we are looking for functional expertise, right? And that's why it's not necessary, by the way, but it's good to have two co-founders because you can have sort of this complementary set of skills. The third thing we're looking for is unique insights into the problem you're trying to solve. This is really, really important. As investors, we are trying to see, do you have unique insights into what your customers want, right? Be they consumers, be they businesses. Do you have unique insight to how consumer behavior is evolving? So we're looking for that, right? The fourth thing is, articulate. Can you explain your business model on the back of a visiting card? If you can't tell me what your business is about and what your mission is in about, let's say one or two sentences, that's not a great sign, because it probably means you haven't really been able to articulate it. And I worry about your ability to be able to articulate it. But it's not just that. We look for a few more things, right? Perseverance is very important. As I mentioned, if you're going to build a large, successful company, it's going to take 8, 10, 12, 15, sometimes 20 years, right? And to do that, you're going to have to go through many ups and downs, many what we call near-death moments. So perseverance is really, really important. And I would argue that maybe perseverance and grit is the single most important thing if you're going to be a successful entrepreneur. So we are going to look at your past experiences to say, what have you done in the past that shows us or gives us signals, shows us that you are a perseverant individual, right? So we'll ask you a lot of questions about your past, primarily because we're trying to understand this. The next one is that you're a missionary, right? Do you have a real purpose? Why are you doing this? So you hear this from investors a lot, which is this question of why, what got you to start this business, right? And by the way, if you, I know some of you probably will say, look, edtech's really hot. Let's go launch an edtech company. That is not a great purpose to launch an edtech company, right? That's why usually the most successful entrepreneurs actually have solved the problem that they personally faced, right? And that actually leads to sort of a missionary founder. So we call that missionary, not mercenary. Ambition, right? We do want to, as investors, and this is especially true for venture capital investors. It's also true for angel investors, but and I'll share that with you in a minute. But do you want to really build a big business? Are you ambitious, right? And then finally, are you we are going to assess your ability to build a team and execute, right? Now, if you've obviously managed people before, even otherwise, a lot of founders have never really managed people before, but we're trying to get a sense of, is this somebody that other people will want to work for, right? So these are the sets of things that we look for in the founding team. And you should keep in mind, if you're trying to raise your seed round, a large percentage of the investment decision is going to be based on the team, right? Whether it's just you, whether it's 3 of you or 2 of you as a co-founding team, and the early set of employees that you've gathered. And this is something that founders don't, especially seed stage founders, don't think of as much. I want to spend a minute on this, which is founder market fit. These are actually, I'm not going to go through this, but I don't know whether you know Girish and his co-founder at Freshworks, right? This is obviously now, very, very valuable SaaS company. Their last round of financing was at $3.5 billion. They built a very, very successful company based out of Chennai, but targeting the world. It's a global SaaS company from India. But Girish and his co-founder had spent many years at Zoho. Right, Girish was head of product, and his co-founder was head of engineering. So both of them had built and run large SaaS products and built SaaS products within Zoho, right, which is a bigger company. So they actually knew a lot about how to build and scale an SMB-focused SaaS product. So when they came out of Freshworks, right, they weren't starting off by saying, how do I go build an inside sales machine, or how do I go think about building products for SMBs, right? So the product market, the founder market fit there was very clear. Next example there is Vivek. Vivek is actually in our current cohort of Surge. Vivek is a global expert in security, and for a long period of time, Vivek was basically doing sort of educational content or delivering webinars and seminars and things like that. And so deep expert in security, and was doing his own thing, which is, basically doing online lectures and so on and so forth. And earlier this year, or late last year, he actually decided that he wanted to build a company around that, right? So when we actually met Vivek, we were like, look, here's somebody who deeply, deeply understands security, right? And has shown in the past that he actually is very good at sort of this whole idea of online education on cybersecurity, right? So there was a reason why Vivek was doing that and why we felt he could win. And finally, Conversite, those are the two co-founders of Conversite. Conversite actually came out of a company called Baby Destination, right? Baby Destination is one of India's largest baby focused communities, and both of them, while they were building that business, actually built a set of tools that they felt would become. They built a set of tools that were very helpful for their own communities. But then after they built that, and while they were using these communities, they realized, hey, wait, these set of tools can also be very helpful for others who actually have large communities, right? So Conversite is still part of Baby Destination, but that's the product that actually they're part of our current search cohort as well. So as we looked at this team, we said, look, here's a team that really understands what community admins really need, because they were community admins themselves, right? And they obviously knew how to build software because they had built the software tools for themselves. Now, there was a lot that they had to learn about how to build a SaaS company, but there was a lot to like there in terms of why these founders had co-founders had the right to win, let's say, in that market, right? So this concept of founder market fit is very, very important. The other thing is we look for in the market, right? What do we look for in the market? At a simplistic level, we're trying to understand, is the market large enough to build a large company? Okay, there are a lot of features that you can build, right? There are small markets that have needs you can build, and then you're going to end up with a small company, right? The second thing we look for is, gross margins matter, and long-term profitability matters, right? So we will look at a market and say, look, is this a business where eventually, not now, because no company makes any revenue or profits now, certainly don't make profits for a long period of time, but eventually, is this a business that can lend itself to, having a very profitable company, right? And then, what you should do is try to understand the level of scale that excites investors in your business, right? Before I joined Sequoia, was a very active angel investor in India and Sri Lanka and the US and so on. As an angel investor, I can tell you that, I would ask the question of, look, can this business get to $100 million valuation company, right? And if the answer to that was yes, then as an angel investor, I was willing to kind of think deeply about the business. So if you're talking to a set of angels, or you're talking to an angel investor, and by the way, 100 million Indian is, you're talking about a 700-800 crore company, right? That is not a small company. That is a pretty serious company, right? But keep in mind that if you're talking to venture capitalists, right, whether you're talking to Surge or Sequoia or Axel or Bloom, they have a higher bar than that, right? Meaning they're asking this question of, can this be $1 billion company? Yes, $1 billion valuation company. Even at seed stage, they're asking that question. By the way, we all realize that very few startups are successful. Even fewer companies will become, as valuable as $1 billion. But we are trying to see, is the market large enough to be able to lend itself to building $1 billion business, right? So having a large market is very important. And what you're going to have to do as founders is demonstrate and show that the market is large enough where you can actually build a business. Next week, when we talk about the pitch, our second session that we're going to have next Saturday at the same time, the entire focus is going to be around these sorts of things that you're going to have to show in your pitch deck. We also ask a very important question called why now? You may have heard some investors ask this question, why now, right? Why now is very important. It says, why is it that now is the right time to build a company like this? And I'm going to give you like 2 or 3 examples, right? Kata Book was in the first cohort of Surge. It's a SME focused software product, right? And why, basically for Kirana stores, like think about it, right? Kirana stores today are open to and are using software at scale because, 3 years ago, Geo launched. So they started getting, data for cheap. They bought their first smartphone. They spent the first couple of years, using WhatsApp and watching YouTube videos. And finally, when a great product showed up that they could actually use in their business, boom, the product just took off. I'll share some of the data with you, right? Meesho is basically the leading social commerce company in India. Meesho happened because, WhatsApp, got to several hundred million users. Today, WhatsApp has 400 million daily active users, right? But as that happened, lots of, almost, half of India pretty much got on, lots of India got on WhatsApp. And that created an opportunity to create a new kind of commerce model, around social selling, right? And so on. So keep in mind, you should try to, if you're building a startup, today after this session, think about each of these things. And one question you ask yourself is, why now? Why is now the right time to be building the kind of company that you're building? The next thing that investors are looking for, especially if you've already launched your product, is product market fit. And it's really, really important that all of you understand this deeply, right? This is the holy grail for a seed stage startup. Not to get your seed round of financing, but if you want to go from seed to A, before you raise your A round of financing, you need to demonstrate that you have, ideally, that you have product market fit. If not, you have early signs of product market fit. And without it, it's going to be very, very difficult for you to raise your seed round, right? If you have launched and have some traction, this is the most important question investors have. Are there early signs of product market fit? Now, what is product market fit? Product market fit, simple way to think about it is user love. Users love your product. They're going to continue to use your product, and they will just, spread the word. They will use the product and so on, right? So user love. And what's the best metric for user love is retention. Retention is the best metric, right? So if you're a consumer internet app, you can think about it as day one retention, day 30 retention, or month one retention, month two retention, month three retention, right? And keep in mind that if you have very high growth, let's say you wrote a consumer internet app, you have very high growth with low retention, that's a really bad sign. So here's an interesting thing that very few founders think about, right? You give me two startups, they're both consumer internet startups. One has 1 million users, but has 8% month one retention. The other product has 10,000 users and has 40% month one retention. Which one do you think an investor will pick? They will pick the product with 10,000 users and 40% month one retention, right? So retention, right? If you're building a SaaS company, we look at churn, right? So let's say you're building an SMB SaaS company and your monthly churn is 6%. Do you know what that means? That 72% of your revenue is going to go away over the next year, right? You don't have a product that users love, right? On the other hand, if you're building an SMB SaaS company and your monthly churn is, let's say, 1%, that is a very, very interesting product because, for SMB SaaS, that's very good, but for enterprise SaaS, it's not, right? Enterprise, you need to be much lower than that. So retention and churn, becomes very, very important. And the other thing is we also look at, things like ratings, right? Play Store ratings, Amazon ratings, Flipkart ratings, G2 Crowd ratings, right? So depending on the business that you're in, if there are users that are actually giving you reviews, we look at those things. So keep in mind that product market fit is very, very important. And if you've launched your product already and you have some early traction, ask this question. By the way, you don't need product market fit to raise your seed round of financing. But if you've looked at it, you should know that this is what investors are looking for, right? So it's okay not to have product market fit because it's very hard to get. Very few companies actually get to it. But talk about how you're going to focus on getting product market fit. Okay, so the only approach to actually get product market fit is to be customer obsessed. You have to deeply be focused on the customer, understand the customer's needs, talk to customers, look at the behavior that customers have on your product, whether it's an app, whether it's a website, whether it's a SaaS product, and continuously run experiments to try to figure out how are you going to get customers to not just use the product once, but continue to use it, increase their time spent, right? So the only way to get product market fit is be customer obsessed. It's not by being technology first. Technology is very important, but only focusing on technology is very difficult to get product market fit. It certainly isn't by focusing on being shareholder driven. So, the more time you raise on fundraising, the less likely you're going to be able to find product market fit. You'll never find it by being focused on competition. And it's also not really about skill sets, right? It's about customers and obsessing with customers. I want to share two examples of companies in our first cohort. Scalar. Scalar is basically focused on taking sort of coders and trying to make them Google quality engineers, taking engineers, software engineers, and making them sort of Google quality engineers, right? And this, they had 350 students, March 19, which is when Surge started in their first batch of Scalar. And what's very, very interesting is, the users loved it, right? And very quickly they figured out that they could really have an impact on the skills that these engineers have. And then, they started getting picked up by all the big companies, and you can see the growth that they've had, right? So this is a company that very quickly found product market fit and then started scaling. The other company is Katabook. It's the company that I talked about. So when Surge partnered with them, they had about 40,000 merchants, but they had very, very strong product market fit. So this is a company that very quickly found product market fit. And when you find product market fit, this is sort of what happens, right? They got to 1 million merchants, and today they have, by far they're the largest product in this category with many, many million SMEs, right? In fact, it's been the fastest growing SaaS company in the history of the world. No SaaS company has ever grown this fast, and I think it's a great indication also of why now, right? Why now for Indian SMB? The next thing that investors are going to look for is if you have revenue, you should show your unit economics, right? So if you have revenue, make sure you understand what unit economics means and then calculate unit economics. And keep in mind a few things, right? High gross margins make investors smile. If you show me high gross margins, I'm smiling. And by the way, high is, depends on if you're a SaaS business, that means something else. If you're a direct to consumer product, it means different, something else, and so on, right? Negative contribution margin terrifies investors. So if your contribution margin is negative, especially today, that is going to make it very, very difficult for you to raise funding. Not knowing your numbers makes the meeting early. So if you're not on totally on top of your numbers as founders and you're pitching to investors and you don't know your numbers, right? That when I say the meeting will continue for the time period, but you should keep in mind that you have lost a lot of interest. And the last and most important thing to keep in mind is the era of growth at any cost ended in March of 2020, right? We are not, as investors today, focused on growth at any cost. We are focused on finding founders and finding startups that are building products that consumers love, right? That have viable unit economics when they actually start monetizing. All right, the last thing I want to get to before I open for questions is how long will it take? Look, the best case is it'll take 4 to 6 weeks, right? So, for instance, Surge has made decisions in even as short as 2 weeks. Mostly it'll take 4, 5, 6 weeks, but that's the best case, right? But normally, how you should think about it is how long it takes depends on how much you're trying to raise. If you're trying to raise 2 crores, it could actually take up to 3 months, especially in the current environment, right? If you're trying to raise 20 crores, it'll probably take between 3 and 6 months. And if you're trying to raise 100 crores in the current environment, it could take much longer than that. So be realistic about how long it's going to take. All right, with that, let's pause. And Payal, hopefully you're still there.
Yes, and lots of questions pouring in. So I'll start with the first one. There are a couple of people who've asked us this. You mentioned that the investor should be trustworthy. Is there a way to protect your idea when approaching investors and sharing information?
Look, the short answer is there is no real way to protect it per se. I think asking for NDAs when you're an idea stage founder is generally not going to work, right? And keep in mind, by the way, ideas are dime a dozen, right? We talked about how difficult it is to launch a product, to find user love, and so on and so forth. What I would say is, look, do the research on the investors who are most likely to invest in your kind of company, right? What's the sector that you're focused on? How much are you trying to raise? And then actually sometimes even before you approach an investor, you can always talk to others who they have invested in, right? So you get some sense of what are they like as an investor. But what you should know is, look, whether it's Indian Angel Network or Mumbai Angels or Chennai Angels, or whether it's Let's Venture. I mean these platforms and networks are very good about making sure that they have the right kind of investors, right? So you can't really go wrong with a lot of the names that I had on those slides.
Okay, the next question is, has the thought process changed in terms of investing in startups which are large businesses but have a loss-making model versus something like a Zerodha which has profitable unit economics?
So I would say, as I mentioned, right, the current environment, if you have what I call negative contribution margin, right? So contribution margin, hopefully most of you know what that means. You take your gross margin, you take out logistics and warehousing, and you take out marketing and sales, and you end up with contribution margin, right? So usually when you have negative contribution margin, it means you're losing money on every order, right? Either every product that you ship, or every room that you're selling, or every whatever that you're doing, right? So having negative contribution margin today will make it very difficult for you to raise financing, and the only option you'll have is your existing investors, right? If you've already, if let's say you're a large business, you raise a lot of capital, you already have investors on your cap table. Your only option at this stage might be for your existing investors to step up. So actually today what you're seeing is a lot of companies in India, in Indonesia, in Southeast Asia, in the US, in China, who have negative unit economics or negative contribution margin, are focused on getting to positive contribution margin, right? By the way, positive contribution margin doesn't mean you're profitable, because you still have your overhead costs, your engineering costs, your technology costs, your support costs, and so on. So it doesn't mean you're going to be a profitable company, but positive contribution margin becomes very, very important. The other thing I would say, Payal, on this point is, keep in mind there are companies that can be built very frugally without actually having revenue that become very, very interesting, right? WhatsApp had 400 million users and very little revenue. I mean, they were monetizing, but not much when they were bought by Facebook for $19 billion, right? Because they had 400 million consumers around the world that completely loved their product, right? Those of you that use WhatsApp, I'm sure you'd all say that you love WhatsApp. You can't live without it, right? And use it, many times a day, right? So if you can build a product which reaches a large number of users, either on the consumer side, for instance, India is going to become a big hub for dev tools companies, right? I'm sure most of you read about a company called Postman just raised a series raise of financing that made it a $2 billion company. That's a dev tools company, right? So they have millions of developers that actually use this platform. So those kinds of platforms can be built, and initially there won't be a lot of revenue. So this whole discussion about contribution margin is really not relevant. But you have to do it in a very frugal way, and you have to make sure that you get to user love, right? Whether it's developers, whether it's businesses, whether it's SMBs, or whether it's consumers.
That's actually interesting, Rajan, because you mentioned user love and you gave the example of WhatsApp. And Siddhant is just asking us, is user love defensible for a free product?
Absolutely, and in fact, if you have a free product, you better have incredible user love, right? Because absolutely, right? You look at the most, like, look at, pick your favorite product, right? Google search, it's free for you. YouTube, it's free for you. Yes, you can buy YouTube Premium, but you look at Facebook is free for the consumer, right? You look at TikTok, it's free for the consumer. So these are all, free for the consumer, right? And the reason these are all products that were able to monetize eventually, right? Search in the early days, and by the way, search, when Larry Page and Sergey Brin launched search, Google was the ninth search engine. It was not the first engine. It's just that it was so much better product. It just gave you better results and gave it to you faster than any other search product. That users started loving the product, and therefore the product started growing, right? Same thing with Facebook. As all of you know, Facebook was not the first social network, right? It was the nth social network. There were so many social networks before it, but it built user love, right? So this notion of user love is something that all of you as founders should spend a lot of time on, right? Make sure that you build a product that users love.
Okay, next question. Karan is asking, what's the different frameworks that we can apply to understand what's a nice to have product versus a must have product? And how can one test it for their own products? Like, do you use market mix, or do you look at an MVP approach?
Yeah, I mean, look, so the first thing is, look, let's say you're building for, let's say you're building a SaaS company, okay? Because this is the easiest way to think about it. And let's say you're building a SaaS company that sells to large enterprises, okay? SaaS startup that's selling to large enterprises, right? So today, if you talk to any CEO of any large enterprise, or any CIO or CTO or CFO, they would say their priority 1, 2, 3 are cut costs, right? So the fourth one is probably going to be work from home and remote collaboration, right? Because a lot of companies are trying to, we have decided that they're going to actually have pretty significant people work from home. The next priority is probably digitalization, right? They want to accelerate e-commerce, online support, and so on and so forth. So you have to sort of say, look, which of these priorities? So can my product help cut significant cost quickly? And what is the ROI that you can deliver, right? So if you're selling an enterprise product today, just ask yourself, look, can I show clear ROI to my client, return on investment, right? If your product can't show clear ROI, and that ROI isn't significant, right? So for a dollar that, let's say, an enterprise invests in your company, or let's say they put, let's say $1,000, right, a month. If you can't show that $1,000 has a clear ROI of $3,000 or $5,000, product, right? It's ROI. I mean, because that's what they're focused on today, right? When pre-COVID, when the markets were great, they were all growing, but all companies were growing really, really fast. They were okay working on things that were nice to have, right? It's not exactly clear how you can measure ROI. Yes, it's a good thing to have. Our teams would be happier if they had it versus not. So that's sort of one way to think about it. And similarly, you can think about it as other products as well. Look at consumer behavior, right? Today, you ask yourself, if you're building, let's say, a direct-to-consumer brand, is this a product category where over the next, call it 6, 12, 18 months, and you're in India and you're selling to Indian consumers, or you could be in Pakistan or Bangladesh or Sri Lanka or Indonesia or Vietnam, is this a product that consumers are really going to want to buy? in the current state, right? And the answer to that in many cases is no, not really. It was fine before COVID, but given the environment that we're in today, and keep in mind, COVID is not a 2-month phenomenon, right? COVID is going to be here until we have a vaccine, and that vaccine is some ways out. And if you give it enough thought, right, depending on the kind of product that you're building and who you're building it for, you will very quickly be able to come up with this answer of, is this must have or nice to have? This is not a good time to be building a nice to have company.
Shifting gears a little bit, Pratyush is asking if the market size is small today, say $150 million, but growing at a 30% CAGR with strong tailwinds, along with the product addressing a core human motivation, is this something that may be interesting to VCs?
Look, if the TAM is only $150 million, and if it's going to grow at 30%, which means in 5 years, maybe it'll get to $600-700 million, that is not a TAM that's big enough, right? However, if it's something that could inflect, so for instance, like nobody would have predicted that online conferencing was going to be as big as it is today, right? I mean, if you had asked me 4 months ago, is online conferencing going to be, online webinars, online meetings, is it going to be as big as it today? I would have said absolutely not, right? But if it's sort of a space where it's growing at 30%, see, 30% growth on a market of 150 million is not, especially if you want to approach let's say one of the larger venture capital firms, right? But that kind of business, if you've built a product, you've got strong user love, and let's say, but you will get the business, you will be able to raise a seed round, but it may be from either a seed fund, or it may be from which is a venture capital fund, by the way, right? All seed funds also venture funds, or maybe from angels, right? So if you need to raise 4-5 crores, absolutely, you should be able to do it. But remember, that is not a big market. A big market, a market size of a few billion is better than a few hundred million. And if you've only got a market of 10, 20, 30, 40 million dollars, that is a small market.
And for B2G companies which have strong unit economics and a huge market opportunity, do you see the funding ecosystem improving for them?
So if you're selling to governments, traditional investors, be they angels or VCs, have been reluctant to invest in those companies, right? Actually, it's one of the things that I've had a lot of discussions with the Startup India team and Invest India team and government of India, because India needs many companies like that. But it's not easy to raise financing, right? But it's not to say that it's impossible. You'll just have to work harder to find investors. So you might actually have to improve. By the way, one category of investors I didn't have there is impact investors, right? Firms like Avishka, firms like Omidyar. There are impact investors who would be more open to looking at companies that sell to government. But keep in mind that maybe taking the Sanjeev Bikhchandani at InfoEdge approach, which is get your customers to pay for it, is the way to actually build that company. And maybe you should end up on that slide with Zerodha, where you built a very large, extremely valuable company without raising external financing. That may actually be the right approach to take, if you're building that kind of company, because raising financing from startup financing from traditional sources will be harder. And again, look, anything can be done, right? You should be going after government grants, because there are a lot of government grants that you can have if you're building something really interesting where you're selling to government, both at the center as well as at the states.
Thanks, Rajan. There are a lot of questions on specific sectors. I think in the interest of time, we're going to try and answer more of the broader ones. There is one which is saying, what is your view on the future of IoT in India and Southeast Asia?
Yeah, look, I think the future of IoT is very exciting, right? In fact, today, just before I got on this call, I was on a Startup India jury. India is having the India Startup Awards, right? And this particular jury with 5 of us was looking at IoT startups, Industry 4.0 startups, IoT, machine learning, AI, and cloud. And there were a whole bunch of companies that were very, very interesting. So I do think, COVID is going to accelerate digitalization across industries. And we're seeing that already. And I think it's going to create some very interesting opportunities for IoT companies. Historically, the challenge for IoT has been, it's taken a very long time to build out these companies. So the growth rates were not as high as we'd like it. But I think some of that is going to start changing now. It's still probably more of like, it's going to take a few years before it gets to prime time. But there's a lot of interest in strong IoT companies that meet a very specific need with the right sort of team.
And since we're
Shall we,
talking of,
Payal,
sorry.
shall we try to finish up, and then I'm just noticing we have 10 minutes left. I want to make sure, I don't think I have too many slides. So shall I finish up the slides and then we'll take the rest of the questions?
Yeah, I think you're actually done, but yeah, sure.
Oh, okay. All right. So, just as Payal said, we've got just two more things to go. This is sort of what we'll cover over the next three sessions, right? The 5 Ps for a perfect fundraise. Prepare your materials. We'll talk about the next week. Practice your pitch. We'll talk about what a great pitch needs to look like. Precise targets. I've talked about that, right? Really do the research so you can figure out the kind of investors that you want to target. Before you approach them. You'll have to actively manage a pipeline. I didn't talk about this today. Next week, we'll talk about it. The reality is you are probably going to get a no in your first 5, maybe 10 or even 15 meetings. So you're going to have to keep going, right? Keep in mind that your fundraise is not going to happen after your first 2 or 3 meetings, unless you get really lucky. So you'll have to be quite rigorous about maintaining a pipeline of who you're meeting, who you're responding to, etc. And patience is going to be required, right? Keep in mind this is going to take time. You're going to have to talk to a lot of investors. Most of you are going to get very frustrated after about a month or 6 weeks, but you have to keep going. You have to keep going, and we'll share some examples of some big names that all of you know and how long it took for those founders to actually raise their round of financing. And with this, now I'm going to answer questions, but keep in mind that next week, again, right, for 4 weeks in a row starting today, for 90 minutes from 4 p.m. India time to 5:30 p.m., we're going to have these sessions. Next week's session is on the art of pitching, how to craft your pitch deck. This is very, very important. Those of you that are seed stage founders, I'd really recommend that you come to this because, again, I joined Sequoia quite recently. I was a very active angel investor for a very long time, and I wish I had known some of the things that we're going to share with all of you next week, because we find that a lot of pitchers don't have the kinds of things that investors look for, and the story isn't told in the way that it should be, right? And why is the story important? And also some very practical tips of what to do and what not to do. So with that, let's take a few more questions, and then I'll wrap up with one last thing. But let's go back to the questions, Payal.
Sure. A couple of questions on folks asking how they can go about finding the right co-founder for their businesses.
Yeah, so look, I think the way you should think about a co-founder is what are the skills that, firstly, start with this notion of founder market fit. Okay, investors are going to look at it, and forget about investors, right? You just need to think about it, because you have to have the right set of skills to build the kind of business you want to build, right? So let's just say you're an engineer, right? And you've been doing engineering, it could be for 2 years or 10 years, and you could be a sort of a relatively very seasoned engineer, or you could be somebody who's just done engineering for 1 or 2 years, right? And let's say you're trying to build either a consumer internet company or a SaaS company. You need to have somebody who really understands product, because remember, to build a product that customers love, you have to be deeply thinking about products, right? Talk to lots of customers, figure out what their needs are, etc. So if you can find, so there, I would say, let's say you're building a consumer internet company, find a co-founder who actually has done product before, has been a product manager, who's really, really insightful, who's actually worked at ideally a company that is well known for building great consumer internet products, right? So that's the first thing, is what sort of skills should they have? And then in terms of finding them, look, you're going to have to meet lots of folks, you're going to have to use your networks, you're going to have to go to a lot of events. That takes time, right? But keep in mind that this is somebody you're going to have to work with for the next 10, 15, 20 years. So be very, very, very selective, right? It's like getting married, right? It's going to last a really long time. Maybe not 50 years, but certainly it's going to be 10, 15, 20 years. So be very, very selective. So figure out what skill sets you need, and then figure out, spend a long time, because look, culturally, you have to be aligned, right? Your value systems have to be aligned. So spend a lot of time making sure you have a set of values, the things that are most important to you. You need to make sure that, your value systems are going to be aligned.
There's a question where someone's asking if you have a great business model, but you don't have any past experience as a founder or any connections within the network. What kind of advice can you give them?
Sorry, say that again. Sorry, I lost you for a second, Payal. Say that again.
Yeah, sorry. So someone's asking that if you're a young entrepreneur who has no past experience, nor any connections within the network, but you have an innovative business model, what kind of advice would you give that entrepreneur?
Yeah, I would first ask the question of why are you building this company, right? Why do you have this mission? Remember, missionary versus mercenary, right? What is the unique insight you have about the space that you're in, and why do you think that this space is, needs a product or a service that you're going to build, right? I would deeply ask that, because I find that too many entrepreneurs just chase trends, right? EdTech is hot. Let's go launch an EdTech company. Digital health is next. Okay, let's go launch a digital health company. SaaS is great. So that is a really bad way to think about what kind of business you want to build, right? So and by the way, some of the many of the world's greatest companies were built. Mark Zuckerberg launched Facebook in while he was at Harvard, right? But he launched Facebook not to become Facebook, because he was trying to solve a problem that he had, right? Similarly, Bill Gates, right, launched a business after while he was in college, but he had been coding, keep in mind, since he was 10. So ask yourself that question, and then what I would do is to sort of say, if for instance, right, if you're, let's say, you're still in university. In fact, 2 weekends ago, I talked to somebody in India who was still in college. He was second year in college. He had some really interesting ideas, and he wanted to build this sort of certain kind of cloud company. He was actually a coder, right? And I said, look, stop trying to raise funding. Stop trying to look for a co-founder. Just build the product and launch it. The great thing about the internet today is if you launch it very quickly, you'll start getting feedback, right? So if you're doing something that you have a natural right to win in, it could very well be that you could get the product launched. I remember last year, as an angel investor, I funded a company. They were doing a SaaS product, and I met this entrepreneur, and about an hour and a half in, he had shown me the demo, etc. And I asked him, so how many people do you have on the team? And he smiled. So he says, take a guess. So I said, I don't know, 7 people. I said, no. He said, no. He said, 10 people. So I said, no. And then he smiled and said, you're looking at it. You're looking at the team. It was just him. He built the whole product. He'd launched it and made it, and it got distribution, right? So, and by the way, not everybody can do that. But all I'm saying is it kind of goes back, right? Fundraising is not the objective. The objective is to build an enduring company. And it starts off, if you're a single founder, what is the unique insight that you have? Why do you think this is going to be? And then if you actually need a co-founder who's, let's say, who's going to be a product person or is going to be an engineering person, then I would do the things that I talked about, which is do the work to really figure out the skill sets that you want on the team, spend a lot of time to try to find the right co-founder. But then once you find the co-founder, try to build it and launch it and see what early feedback that you get. At Google, we have this thing, right? Launch and iterate. Sort of best way to know whether there's a market for it is, firstly, be very thoughtful. Think through why it is that you want to build this, right? But once you've decided and there's a compelling reason, build it, launch it, and you can do that in consumer internet. You can also now do it in SaaS, right? Many kinds of SaaS companies, you can actually build it, launch it, and co-develop it with customers, for instance. Right? If you're launching a SaaS company, you can find, if you can find 4 or 5 companies to co-develop your product with, and those companies agree to co-develop it with you or be your early customers, that shows that there's probably a real need that you're trying to meet.
There is a question from Gauri saying, can you shed some light on SaaS B2B or B2G companies in India and US? Should I focus on ROI or revenue? And are Indian investors only looking at B2C, especially for something like medical software, where does it have to be a domain product, or is it okay for the common man to be a direct user? It's a slightly long question. Do you want me to repeat
long
it?
Question, and there are long question, and there are many questions.
Shed some light on SaaS B2B or B2G companies in India and US.
I got it, Payal. So look, the first thing you should keep in mind is there's a lot of investor interest in SaaS companies. Okay, as I said, this decade, the decade in India from 2020 to 2030. Is the decade of SaaS, the decade of Indian SaaS, okay? Because keep in mind that 2 years ago, India had 0 SaaS unicorns. Then Freshworks became a unicorn. Then you had Druva. Then you had Icertis. And the most recent one is Postman. So basically in 2 years, we've gone from 0 SaaS unicorns in India to 5 SaaS unicorns, right? I think we'll easily have 15 SaaS unicorns, Indian SaaS unicorns by 2025. And then from there on, the pace is going to accelerate, right? And there's many reasons for that, by the way, we can get into. So firstly, you should keep in mind that, there's a lot of interest. Now, what I would go back to, if you're trying to build a SaaS company, ask yourself, are you very clear who the customer is, right? Are you trying to sell to a large enterprise? Are you trying to sell to a small business? Are you trying to build a dev tool? Are you trying to, who is the customer, right? Really ask yourself. And then second, focus all your energy on building a product that customer is going to love. Okay, so if it's a large enterprise, get a couple of large enterprise customers to agree to be your early customers, right? So that you can build the product along with them. So that way you really know that you've got a product. If it's an SMB product, do a lot of research to figure out that SMBs really need it, then quickly build the product, get it out there, and see if the product sticks. Because remember, retention is what's going to give you a sense of user love, etc. Right? And for instance, right, like I was an angel investor in a company called Innovator. Right? Innovator has it's a India US company, cross border SaaS company, doing extremely well. They make an analytics platform for a SaaS based analytics platform for healthcare providers in the US. Right? I mean, it's literally gone from $1 million of revenue to over $40 million of revenue in a couple of years, right? SaaS revenue. So because they actually, built a product that providers absolutely need, right? It's a must-have product. So those are some thoughts as you think about SaaS. But keep in mind, this is going to be the decade for India SaaS, and not just India SaaS, right? South Asia SaaS, Southeast Asia SaaS, because SaaS we're going to see massive amounts of innovation from our region.
Thanks, Rajan. In the interest of time, I think we'll keep it to two last questions. The first one is, how many women-owned businesses has Sequoia invested in, and Sequoia and Surge? And do you think more women are coming forward to avail the opportunities in starting up?
Yeah, it's a great question, by the way. If you look at our current Surge cohort, actually, we've invested in a large number of, Sequoia has invested in a large number of, I think at last count, and Payal would actually know this number better than I do. I think we had 29 or 30.
It's 40 now.
It's 40 women founders in the Sequoia portfolio, which is a large number. And actually, if you look at our current Surge cohort, 33% of our founders are women, right? So 33% of the companies are founder have either the founder like a Nelly or the co-founder like Nelly is the founder of Tiger Hall, or Prakalpa or Tamanna, who are the co-founders of their respective companies. Nat Habit in India, right, is a co-founder. So actually about a third of our current Surge cohort is women co-founders. And if you look at across Sequoia portfolio, Sequoia India portfolio, by the way, I'm not talking about Sequoia, right? This is Sequoia India portfolio, as Paya just mentioned, 40 women founders, which is actually a large number. And we've got some many incredible women founders. And then what was the other question, Payal, tied to this?
Are more women founders coming forward now? Are there better opportunities for them?
Yeah, no, absolutely. Look, at the end of the day, it's a great time, despite what is going on around us, right? Maybe I'll end with this, which is, look, we are obviously in a crisis we haven't seen in 100 years. There's it's very, very challenging for humanity. It's very challenging for all of you and your families and so on. It's very challenging for economies, for all businesses, for startups. But on the other hand, this is the time, if you really want to be an entrepreneur, and you've got very strong insight into problems that you want to solve, and you're going to be missionary about it, right? It's a great time to be launching a company. And by the way, and that doesn't matter whether you're a man or a woman. So I would say, it's a great time for women to be launching companies, as long as they're very clear, right, that they believe they have found a market fit, and they're very clear of the kind of business that they want to launch and why they want to go build it.
That's it from me, Rajan. Thank you so much.
Okay, terrific. Thank you so much, Payal. And as a way to wrap up, guys, thanks again for everybody who's dialed in. We hope that this session was useful to you. Again, this is the first part of a 4-part series of what it really takes to raise a seed round. And we'd really encourage you to join this series every Saturday at 4 p.m. Next week, we'll have another leader from Surge who'll come and talk about how to craft your pitch deck. And then the last thing I'd say is, if you are currently raising a seed round, we'd love to hear from you. You can go to surgeahead.com and apply. It's very easy. We are currently in the process of selecting who we're going to partner with. In fact, we've already selected a bunch of companies that are going to be in our next cohort, and we'd love to hear from you. With that, have a great Saturday, everyone. And thank you, Payal. And also thank you, Gautam, and I want to thank Startup India team for partnering with us to do this. We'll see you guys next week.
Thank you so much, Rajan. It was an amazing session. There's so much engagement during the session, and you talked about user love and how it is so important. And during this session, we've seen so much viewer love from our audience who've been constantly engaging with us throughout the session. We'll also, like you said, the next session is the same time next week, and we would look forward to all of you joining us again as a part of this, series of how to go about, the complete process of being ready and pitching now. The next session is going to focus on how exactly do you finally present your company, your idea to the investors, and we'd love to see you there. Thank you so much,
All right.
Payal and Rajan.
Thank you, Gautam. Thank you, Payal. Thank you, everyone. See you guys next week.